Why billionaires are quietly dumping stocks for silver before the panic. In the fourth quarter of 2024 and extending into early 2025, a specific and highly unusual pattern emerged in the filing data of the Securities and Exchange Commission. According to verified Form 4 documents analyzed by Verity Data, corporate insiders, specifically the founders and CEOs of the world's largest technology companies, began liquidating their personal stock holdings at the fastest rate observed since the market peak of November 2021. Jeff Bezos sold $8.5 billion of Amazon stock in roughly 9 trading days. Mark Zuckerberg unloaded over $500 million of Meta. The Walton family liquidated $1.5 billion of Walmart stock in a single week. While mainstream financial media describes this as routine estate planning, analysts tracking the flow of funds have noticed a simultaneous anomaly in the commodities market. As billions of dollars exit the equity markets, private family offices and sovereign entities are quietly accumulating physical hard assets at a pace that currently exceeds mining supply. But before we analyze this data, I must be absolutely clear. This video is for educational and informational purposes only. I am not a financial advisor. All opinions shared are my own and based on publicly available information. Please do your own research before making any financial decisions. In this video, I'm documenting a pattern known as the liquidity rotation cycle, a sequence that is repeated across multiple supply-demand crises in recorded history. Here is the data, the history, and the analysis of what is unfolding right now. Commodity historians and market analysts have documented a recurring sequence that appears during late-stage economic cycles. I call this the Liquidity Rotation Framework, not as a prediction tool, but as an analytical lens for understanding how capital migrates during periods of systemic stress. It's important to note, markets can behave irrationally, timelines vary dramatically, and past patterns don't guarantee future outcomes. History doesn't repeat exactly, but as Mark Twain allegedly said, it often rhymes. Here's how analysts break down the pattern based on historical observation. Stage 1 is the valuation peak. In this stage, equity markets reach historical highs relative to GDP. Sentiment is euphoric, and retail participation is at its peak. However, smart money, institutional insiders, begins to identify that future growth is priced for perfection. They begin to distribute or sell stock into the strength of the rally. Stage 2 is the quiet accumulation. This is the phase analysts suggest we may be observing now. As capital leaves overvalued paper assets, it does not sit in cash, which loses value to inflation, but migrates into undervalued hard assets. Historically, this has been land, art, gold, and specifically silver. The price of the hard asset often remains stagnant or suppressed despite heavy buying, as large entities fill orders slowly to avoid spiking the price. Stage 3 is the liquidity vacuum. This occurs when an external shock exposes the lack of liquidity. The broader market realizes that stocks are overvalued and commodities are scarce. The smart money has already positioned itself. Stage 4 is the tangible repricing. The final stage involves the public rushing to enter the asset class that insiders bought in Stage 2. This is characterized by exponential price increases and shortages at retail bullion dealers. Now, I'm going to walk you through 2 documented historical cases where this pattern emerged. Then we'll examine current data to see if similar conditions are present today. To understand the current insider selling, we must look at the Nifty 50 era of the early 1970s. This period provides a textbook example of the liquidity rotation pattern. According to Federal Reserve Historical Archives and market data from the New York Stock Exchange, here is how the situation developed. From 1968 to 1972, the U.S. stock market was dominated by 50 popular large-cap stocks, companies like Xerox, Polaroid, IBM, and Avon. They were called one-decision stocks. You bought them and never sold. Valuations were extreme. Polaroid traded at 90 times earnings. The consensus was that these companies were invincible. However, Federal Reserve data shows that during this period, European central banks began quietly exchanging their U.S. dollars for gold, sensing that the currency was being debased. Insiders were exiting the dollar assets. By 1973, while retail investors were still piling into the Nifty 50, smart capital began rotating into commodities. The Hunt brothers, famous Texas oil tycoons, began accumulating silver when it was trading under $3 an ounce. They weren't speculating on a squeeze yet. They were simply moving capital from paper assets, which they feared, to physical assets, which were cheap. The catalyst arrived with the oil embargo. The illusion of infinite growth shattered. The Nifty 50 crumbled. According to Bloomberg historical data, Polaroid shares fell 91%. Avon shares fell 86%. At this point, the market behavior shifted. As stocks crashed, capital didn't just vanish, it moved. Silver prices began to climb, decoupling from the equity market. By January 1980, the rotation had turned into a full-blown mania. Silver executed a historic move, rising from those low single digits to an intraday high of $50. Those holding the safe blue-chip stocks experienced a lost decade. In real terms, adjusted for inflation, it took them nearly 20 years to recover their purchasing power. Conversely, those who identified the rotation in Stage 2 experienced a massive increase in purchasing power. Fast forward 30 years to the Dot-Com Divergence. We see the framework emerge again, though the catalysts were different. From 1997 to 1999, the NASDAQ composite rose exponentially. Companies with zero revenue were commanding multi-billion-dollar valuations. Insider selling in the tech sector was rampant. Executives at companies like Yahoo and AOL were liquidating shares at a record pace. While the world was distracted by tech stocks, Warren Buffett executed one of the most famous contrarian trades in history. According to Berkshire Hathaway's 1997 annual report, Buffett purchased approximately 129.7 million ounces of silver. His logic was simple. Supply was falling, demand was rising, and the price was historically low, around $5 an ounce. He was rotating capital out of overvalued markets and into a depressed asset. And look, I want to pause here for a moment. As we examine these billionaire trades, it is crucial to remember, this video is for educational and informational purposes only. I am not a financial advisor. All opinions shared are my own and based on publicly available information. Please do your own research before making any financial decisions. Following Buffett's trade, the dot-com bubble burst. The NASDAQ lost 78% of its value. Trillions in paper wealth evaporated. But following the crash, the Federal Reserve cut rates to stimulate the economy, the dollar weakened, and this triggered a massive bull market in tangible assets. From the 2001 lows to 2011 highs, silver rose from roughly $4 to nearly $50 again. And when we compare the 1970s and the 2000s, several similarities emerge. Both experienced massive equity overvaluation in Stage 1. Both saw smart money position into metals before the crisis became obvious, and both resulted in a decade-long bull market for precious metals. Before we examine current conditions, it's important to consider opposing perspectives. Not all analysts agree with the supply stress thesis or the idea that insider selling signals a crash. Some analysts argue that the recent selling by Bezos, Zuckerberg, and the Waltons is merely routine estate planning and tax management. CNBC market commentators have noted that stocks are at all-time highs, making it a logical time for founders to cash out for philanthropic or lifestyle reasons without it signaling a lack of faith in the company. However, when examining the data, the sheer volume, billions in a single quarter, is statistically deviant from standard annual selling patterns. Other economists point out that if insiders are selling, they are likely moving to high-yield cash like treasuries, not silver. With interest rates hovering around 5%, cash offers a risk-free return. While true for short-term capital, history shows that during periods of high debt monetization, real yields on cash are often negative. Billionaires looking at multi-generational preservation often prefer assets that cannot be debased. These counter-arguments deserve serious consideration. Markets are complex, adaptive systems. The pattern I'm documenting isn't guaranteed to play out identically. Variables include AI adoption speeds or successful soft landings by the Fed. What I'm presenting is pattern-based scenario analysis, not inevitable prophecy. Now let's examine recent data to see if similar conditions to our historical cases are present today. Remember, Similar conditions don't guarantee similar outcomes. Current data from Verity Data and SEC Form 4 filings presents a striking picture. The ratio of insider selling to buying has reached levels reminiscent of the 2021 peak and the 2000 dot-com peak. We are seeing cluster selling, where multiple executives at the same firm sell simultaneously. Analysts comparing this to historical cases note that this behavior typically precedes a rotation. But while billionaires sell paper stocks, who is buying the metal? According to the Silver Institute and World Gold Council, central banks have bought gold at the fastest pace since 1967. While this is gold, silver historically correlates with a lag. Furthermore, data from the Indian Ministry of Commerce shows massive silver imports in early 2024, creating a physical squeeze in the London vaults. Solar demand has also surged to a record, consuming nearly 20% of the total global supply. Before we dive deeper into the supply deficit numbers, let me be clear once more. This video is for educational and informational purposes only. I am not a financial advisor. All opinions shared are my own and based on publicly available information. Please do your own research before making any financial decisions. This is about methodology, not recommendations. Recent reports from the Silver Institute show a structural deficit of over 180 million ounces. Mine production has stagnated while industrial demand has risen. Above-ground stockpiles in London and New York have been drawn down significantly since 2021. When mapping current conditions to our historical framework, equity valuations align with Stage 1, insider selling aligns with Stage 2, and physical deficits align with Stage 3 precursors. Based solely on pattern comparison, current conditions show significant overlap with the distribution phase of the cycle. This suggests the possibility, not certainty, that capital is beginning to rotate from paper to hard assets. Analysts examining historical supply-demand dislocations have modeled several potential scenarios. It's crucial to understand these are possibilities based on past precedent, not guaranteed predictions. Scenario A is the stagflationary breakout. If inflation remains sticky and the Fed is forced to cut rates due to a banking crisis or debt interest payments, capital could flee bonds and stocks simultaneously. Silver, acting as both a monetary and industrial asset, could see investment demand overwhelm the physical deficit. Prices in the 1970s moved 5 to 10 times higher over a decade as the dollar lost purchasing power. Scenario B is the deflationary crash. If the bubble pops and creates a liquidity crisis, initially, everything sells off as investors raise cash. However, historical precedent suggests metals bottom first and recover fastest as the central bank response devalues the currency. In 2008, silver fell 50%, then rallied 400% by 2011. Scenario C is the soft landing, where the economy slows but doesn't crash. Stocks trade sideways, and commodities grind slowly higher due to structural shortages but do not spike. For those studying these dynamics, professional analysts typically structure their research by monitoring specific data points. They don't guess what billionaires are doing. They look at SEC Form 4 filings via the EDGAR database. They monitor physical market tightness using the Silver Institute Annual Survey and COMEX stock reports, and they study historical precedent, reviewing the Hunt Brothers era and the post-Great Financial Crisis era to understand the mechanics of these moves. We've examined a documented historical pattern where smart money rotates out of equities and into hard assets during late-cycle valuations. We've compared the 1970s and 2000s to today's data, highlighting the massive insider selling and the structural silver deficit. Key analytical findings show that insiders are selling stocks at a pace reminiscent of previous market tops, while physical silver is in a structural deficit for the third year running. Historical precedent suggests that when these two factors collide, a revaluation of hard assets is a high-probability scenario, though timing is unknown. I create this content to document patterns, analyze data, and facilitate informed discussion, not to provide financial advice or predict the future. If you found this analysis valuable, consider conducting your own research using the SEC and Silver Institute sources mentioned. What's your perspective? Is the billionaire selling just tax planning, or is it the start of the Great Rotation? Let me know in the comments. I read and learn from every thoughtful response. Thank you for engaging with historical pattern analysis. Until next time, stay curious and stay informed.